Okay, good morning, everyone. Thank you for joining us today for our later life planning webinar. Today we'll be talking about business owners of trading companies that are sort of working towards retirement or their exit from the business. And it's just looking at making sure that people are maximising the value of their business, also reducing their tax liabilities, and that's going to be mainly capital gains tax and inheritance tax. And we'll just be running through a bit of a case study just to sort of emphasize some of the main points that people need to be thinking about. The webinar is being recorded, so it will be going up on the website at some point. So there'll be a chance to either re-watch it, or if people haven't been able to make it today, then they can watch it at a later date. And you will notice on your screens there is a questions and answers box. So if you do have any questions throughout the webinar, feel free to add any questions, and at the end we're trying to save a little bit of time just to sort of run through some of those questions as well. So today I will be presenting the webinar along with my colleague Michael Welsh. So I'm a director at Knight Slow who has I have a client bank of small and medium-sized companies, and I deal with some of the tax projects in the firm as well. And Michael Welsh also has a portfolio of clients that he deals with, dealing with all their accounts and tax affairs, and he also gets involved in some of their tax projects in the firm as well. So in terms of trading companies building up to their exit from the business, there are various different options that people have, or businesses have, in terms of how they exit themselves from the business. So we're going to talk through some of the options, but the point here is the planning towards exiting the business. It's very difficult to be in business and then all of a sudden leave the business or sell the business next week, next month, or anything like that. So we're really just going to be looking at here the period, and it might be a 3 or 5 year period before the sale or exit from the business, that people need to be thinking about the different options available to them to make sure that that's going to work well in their situation. So some of the options that we've got here in terms of exits from the business: you've got family succession. So that might be where you've got mother or father are running the business and they're looking to pass the business down to the next generation. There's different ways that you can do that. Some ways maybe allow mother and father or the current business owners to extract some capital from the business. It might be that you gift some shares in your lifetime to give the next generation some shareholdings in the business at an earlier date, or it might be that the business is passed down a generation via the will on death of the current owners. So there's different ways of doing that, and there's not necessarily a wrong or right way, but it's just making sure that, having looked at the situation and the circumstances in relation to that particular business, that it works for that scenario. So obviously with family succession and with any sort of succession of the business, we need to be making sure things like the new generation or the new owners are going to have the knowledge and the skill sets to be able to take on the business. So from an early stage, it's sort of planning from that point of view in terms of making sure all those duties, all the different tasks that are required to be carried out for the business are carried out by the new owners. Another option you've got is management buyouts and buy-ins, slightly different, but kind of the same kind of setup. Very similar to family succession in the sense that you're kind of looking for someone who's potentially in the business already, who are going to be ultimately running and owning the business in the future. Again, when we're looking at the planning for this, we're kind of looking to make sure that there's the management team in the business that have the skill sets and the desire to take over the business. It's not for everyone running a business. So, having that conversation with that management team at some point, just to say, this is my plan for passing on the business. Is this of interest? Is really important. And Yeah, and if you haven't already got someone in place who potentially will take on the business, then it's a case of, well, can you look to get someone in, learn the business, understand how the business works, so that process can be an option available to you to exit from the business. There's also obviously a full sale of the business. So, I mean, Michael's going to talk a little bit in terms about preparing the business for sale and maximising the value of the business. But again, it's something that we want to be planning at least 3 or 5 years in advance in terms of a full sale of the business, to make sure that you're maximising the value of the business and you've got all the systems and controls in place that you need to make it more attractive to any buyer. It's worth bearing in mind with most exit options, and in particular for full sales, it's quite common to have a holdover period where the current owners are working for the new owners for, say, 12, 18, 24 months or something like that. So again, it's just worth bearing that in mind when we're looking at timescales, to make sure that you've got a realistic date of not working in the business anymore. The final option I've got on here is that the current owners still own the business. They don't actually dispose of the shares of the business, but instead they get a new management team within the business who kind of run the business for them. So the advantage of that is that you're still receiving the profits made from the business, so you're able to take salaries and dividends and what have you. You don't necessarily get the lump sum cash realization for the value of the business today, because you're not selling the shares, but it can work as kind of a nice pension pot of sorts, I suppose, if you can get the right management team and the right incentives for that management team to ensure that they're running the business profitable and that they're focused and driven to try and make the company as profitable as possible. So that might work by paying them a salary with a nice bonus structure reflecting the profits of the business, or it might be something like giving them a small shareholdings, EMI share options or something like that, so that they have actually got a vested interest in the business as well. So I appreciate that's not all of the exit strategies, but it's kind of more common ones that we see for SME clients that we've got that need to be considered beforehand, so that people can understand how this process is going to work going forward.
Right, thank you, Kirk. Good morning, everyone. So preparing a business for an exit, as the top bit says there, the key here is to plan ahead. And as Kirk just mentioned, by planning ahead, we would recommend looking at these probably a good 5 years before you're looking to sell. So the most obvious thing I'll probably say all day is, if you're looking to sell your business, you want to get as much for it as possible. So you want to increase the value of your business, and we'll look at some of these options shortly. But ultimately, how do you value your business? You know, it's not just about valuing your tangible physical assets and the surplus cash that you have in the bank, but what about those assets that we cannot see or touch, such as your brand, your reputation, your client list, your order books, etc. You know, what type of value can we put onto these? They're obviously worth something. And ultimately, as with anything tax, it's not a straightforward answer, but it's of course something that we could help you with as and when the time comes. The second thing on here is about building resilience. You know, can your business cope with tough times? In our current climate, we've got interest rates going up, we've got inflation going up, and the cost of living is going through the roof. So is your business in a strong position to ride these tough times? Does your business have a good track record of riding these tough times, such as how did you get on during COVID? You know, it's looking at the kind of what computer systems you have in place that allows you to manage and grow your business. We're seeing a big shift to working, you know, hybrid working from home, and can your business cope with that? Obviously, the more resilient your business is, then the greater its value to any potential buyer. Perhaps the second most obvious thing I'm going to say today is, whilst you want to get as much for your business as possible, you also want to keep as much as possible. But inevitably, the tax man is going to want their slice of the pie. So what can we do, and what can you do to ensure that we reduce their slice as much as possible? On the next slide, we are going to see a fantastic relief known as business asset disposal relief. But, you know, if that's not enough, if you need more allowance, what more can we do? Can we pass shares to your spouse? Can we pass shares to your children? Could we put shares into trust? There are things that we can do, but the whole key here is planning ahead, because there's qualifying periods for holding shares, etc., that we need to consider. So it's not just putting it into place and selling tomorrow. Number 4 on this slide does seem a little bit counterintuitive, because if you're looking to sell your business, why would you invest in it? But ultimately, it's all about making your business as attractive as possible to potential new purchasers. Are you investing in new machinery? Do you invest in your buildings, or are they all falling apart? How up to date, again, is your computer systems? Can the buyer come in and hit the ground running, or will they need to spend a lot of money bringing all your systems and computer systems and stuff like that up to date? If they do, that will, of course, have an adverse effect on the value of your business. Number 5 is arguably vital for the day-to-day running of any business, and not just in the event of a sale. Do you have highly trained staff that are integral to the success of your business? Can your business run smoothly without you? The more smoothly, I suppose, it could run without you, the more attractive it is to a potential buyer, as again, they can just come in and hit the floor running. So once again, it's just about making your business attractive to potential new buyers. And finally, on this slide, systems and controls and DD's due diligence here. This is perhaps the most scariest part of selling your own business, because the buyer's going to come in, do their due diligence, and look through all of your controls and systems. So are there any skeletons in the closet? How confident are you in the systems and controls that you have in place? Do you have a good accounting system? Do you have good credit control? Do you have good cost control? It's all about building this overall confidence, and in turn, increasing the value of your business. So on the next slide, as I've just mentioned, we've got, sorry, Kirk. Yeah, thank you. Business asset disposal relief. This was once known as entrepreneurs relief, and I've got no idea why they decided to change the name of it, but ultimately it's worth up to £100,000 in tax relief to you. So it's certainly not something to be sniffed at. As we're aware, probably all aware, capital gains is taxed on the sale of a business at either 10 or 20%. 10% is whatever you have remaining of your basic rate of tax left once you've done your tax return. So to be honest, if we're looking at selling a business for hundreds of thousands or even millions, the 10% bracket is going to be minimal, if not nil. So the bulk of the sale of any business is probably going to be at 20%. But what business asset disposal relief, BADR, does here is it reduces the tax rate on the sale of your business down to 10% for the first £1 million. Everybody has £1 million lifetime allowance, hence the £100,000 relief. But as we've mentioned a few times, planning is absolutely vital, because we need to ensure that we tick the boxes. You need to have held the shares for at least 2 years. You need to be an employee of the business or an officer, such as a director. It needs to be a trading company, and you need to hold at least 5% of the shares. So as you can see, it's an incredibly effective relief. But what happens if your business is worth more than £1 million? Say, what if it's worth £2 million? Could you pass your shares on to your spouse, so you each have £1 million and have the whole sale at 10%? And this goes to show how vital planning is, because you would need to pass those shares to your husband or your wife, and they need to have held them for at least 2 years in order to qualify for this relief. So that's why long-term planning, as we've said, is vitally important. Right, thank you.
Thank you, Michael. So yeah, I mean, obviously there's a number of important tax implications on selling the business. One is capital gains tax that Michael has just talked through, and we'll look at the importance of that in a minute when we go through a case study and just understand the numbers on that. The other tax implication is inheritance tax, and I think this is possibly one that gets missed or not really thought about as much on the disposal of the business. And I'm not going to run through inheritance tax in a great detail. I'm going to have a quick overview of what the tax is, but it's more looking at the implications of it on the sale of a business. But just very quickly, inheritance tax is a tax on either someone's death or when they're gifting assets to someone else. The rate of inheritance tax above the available nil rate bands is 40%. So it's quite an expensive tax bill, especially when, you know, someone may have been working and paying income tax at 40% or even higher, possibly throughout their lifetime, to then be in a position where potentially another 40% is payable to the revenue on their death. I think it's quite hard for some people to take that in, kind of thing. There's quite a lot of tax when you look at it in that way. The first £325,000 of wealth is tax-free. That is the value of the nil rate band. So that's the value that you can have, which isn't subject to inheritance tax. For some, you are also able to claim the residential nil rate band, which is worth another £175,000, as long as you are passing your home down to the next generation, your descendants. So that might be your children, stepchildren, grandchildren, something like that. So that home has to be passed down to the next generation through your will on your death. And that allowance only applies only applies in full if your estate is below £2 million. If it's above £2 million, that allowance starts to taper away until when you get to a certain level of value of estate, then that full allowance has been tapered away. As well as your individual allowances, you are also able to use your spouse's unused allowance. So this is very often what we see is if you've got husband and wife, then what will happen is on first death, all of the assets pass across to the surviving spouse. That is spouse exempt, so it's not taxable for inheritance tax. And that means the second spouse has two of those allowances, or ultimately £1 million or up to £1 million of wealth they can pass down to their chosen beneficiaries free from inheritance tax. What we're seeing through statistics that are available to us is that the tax yield through inheritance tax is increasing year on year. So I think it was up 14% on last year, or for 2021, 2022, it was up 14% on the previous year, and it generated £6.1 billion worth of tax. And ultimately what's happening is because property prices are going up, and with inflation running at 10% or close to it, like we are at the moment, we're seeing more and more people that are get caught for inheritance tax because the value of their estates are increasing. So it's definitely one that needs to be considered more and more as we move forward. Something else which is a very valuable relief for inheritance tax is business property relief. So business property relief is a relief that applies to trading companies that are wholly or mainly trading. And it essentially means that the value of your trading business is completely free from inheritance tax. Now, this is, like I say, it's an incredibly valuable relief because more often than not, the value of someone's business is one of their most valuable assets in their estate. So to have that completely tax-free is incredibly valuable. However, it only applies whilst the business is owned. And I think this is really the point that I want to hammer home today, is to say, you know, someone's situation changes significantly from the point that they own the business and they've got an asset in their estate which is extremely tax efficient. And then the next moment they've sold that business. And let's say, for example, that they've just got cash for the sale of the business, then that asset isn't very tax efficient from an inheritance tax point of view. And it can result in a potential large inheritance tax liability for them. So that's the main point. And again, we'll look at some examples where we can sort of see the problem, and then we can sort of talk through some possible options available to people to plan towards that. But yeah, it's a very valuable relief, and it's important to realise the loss of that relief when the business is sold.
Right.
So do you want to run through the case study, Michael?
Yeah, of course. So we talked around the problem, but I often think that looking at figures is far easier to look at this. So we're going to look at this example. We've got a husband and wife. They own a house that's worth £750,000, and they have savings and other assets of £250,000. It's quite nicely total of £1 million. And then the wife owns 100% of a business that's currently worth £2 million. So we've got three different options here showing how planning can work. On the first option, obviously no planning. I must admit, from the slide that we just talked about, business asset disposal relief, I don't know how she qualifies, but this maybe she doesn't claim the relief on her tax return. So with no planning, and assuming that she sells her business for £2 million and there was no cost to acquire the business, she has got a gain of £2 million. So she's going to have proceeds of £2 million. Everybody has a capital gains annual allowance of £12,300, which they can have a gain tax-free up to that value. So we take that off, assuming she's got no other gains in the year, which gives her a taxable gain of £1.9877 million. We're assuming she's at a high rate taxpayer. So at the full 20%, that is a capital gains tax liability of just shy of £400,000. So the next slide, she claims her business asset disposal relief because she's owned the shares for at least 2 years. She owns 100% of the shares. It's a trading company, and she works for it. She's a director shareholder. So we will have the same taxable gain because we've got the same £2 million gain. However, the first £1 million of her gain is now taxed at 10%. So therefore, this reduces her overall tax liability for capital gains to just under £300,000. So this is effectively saving that £100,000 worth of tax that we've seen on the slide before. We've quite nicely picked these figures here because £2 million means she hasn't got enough of her own allowance to get the whole gain at 10%. So what if we were to pass half her shares onto her husband? That would mean that, again, we've still got the same £2 million gain, but we've now got two capital gain allowances, which gives us a slightly smaller gain, but because we're talking about such large figures, doesn't make much difference. But now they've each got their own allowance of £1 million, which means that the whole gain is now taxed at 10%, giving a tax liability of just under £200,000. So they've effectively, from going from no planning to sharing the company and claiming business asset disposal relief, they've halved their tax liability. So it does show how incredibly attractive this is and how planning is vitally important, because the husband would have had to hold the shares for 2 years, etc., etc. But obviously, this is a very simple example, and every situation is different, So what happens if the gain is, say, like over £2 million? What could we do? Well, we could obviously pass the shares down to our children, pass it to other family members. Could we put shares into a trust? It's just all about reducing that tax liability on the gain, so you keep as much money as possible. And if you need any kind of details or any specific help, then please feel free to contact us.
Thank you, Michael. I think the key is that every scenario is different. So like Michael said, the numbers work nicely here for a £2 million disposal. But if there is more of a gain, then there's other options available. Some may be suitable, some might not, but it's just looking at the specific circumstances again, just to see what works. Okay, so now if we turn our attention to the inheritance tax position. So what we've got here on the left-hand side is the position before the sale. So the husband and wife between them, this is looking at their joint position. They had their house worth £750,000, their savings or other assets of £250,000, and they had the value of the business, which was £2 million, total estate of £3 million. Like I mentioned before, they've both got their nil rate bands of £325,000 each. So that's the first £650,000, which is free from inheritance tax. Because the estate is above £2 million, the residential nil rate band is fully tapered. So this client possibly will not qualify for that relief, assuming all of the assets on first death passes to the surviving spouse. And then that surviving spouse is effectively the IHT taxable event when they pass away. There might be some planning there to do to try and access that residential nil rate band on first death, but I'm not going to go into that in any more detail here because it's not really what we're looking at today, not that aspect of IHT planning, but there is certainly some planning there to obtain some of that residential nil rate band by using it on first death, essentially. But importantly, on this scenario, because the husband and wife still own the business, they will qualify for business property relief, assuming it's a qualifying company, a trading company, which means that the taxable value, not the taxable gain, but the taxable value of their estate is £350,000. Now, assuming that the IHT rate is 40% at the time of their death, then that will create an inheritance tax liability of £140,000. If we compare that to the position immediately after they sell the shares, or there's a contract in place forcing them or binding them to sell the business, then obviously the house is still valued the same. The savings, other assets has now increased. So that has increased from the 250. An extra £2 million has effectively gone into savings, less the capital gains tax payable on the sale of the business, which means they've got a slightly smaller estate to reflect the fact they have paid that capital gains tax liability. As before, we've got the two nil rate bands of £650,000, which is tax free. There's no residential nil rate band again, and this time there is no business property relief that the estate qualifies for. So the taxable estate has jumped quite significantly now from 350 to just over £2 million. And the inheritance tax position has significantly gone up from £140,000 to £851,000. So that's an increase of about £711,000, or 6 times what the IHT liability previously was. And I think you probably all agree that this is something that seriously needs to be looked at and planned for, because as soon as that business has been sold, there is a huge IHT liability on that estate, which, as things stand at the moment, that £851,000 would be payable to the revenue and not down to your chosen beneficiaries. So it wouldn't go down to your children, your grandchildren, or whoever it might be. So that is something that is well worth planning towards. So what are the options? So the first potential idea to mitigate that inheritance tax liability is that you could not sell the shares in the business. So this may be looking at an exit plan of retaining the shares, but you've got family members, children perhaps, who are running the business for you. Or it might be that you've got a management team in place who's running the business for you, and you're holding the shares, and you are, receiving an income from that company, whether it be salary or dividends or whatever else it might be. So obviously the main advantage is, because you're still holding the shares in the business, you still qualify for business property relief. So you're still keeping that preferential inheritance tax position that we saw on the previous slide a moment ago. You'd also save the capital gains tax because you're not selling the shares. So there's going to be that significant tax saving that you're going to make as well. And like I mentioned before, you can continue to draw the salary and dividends from the business to help fund your retirement. In terms of the disadvantages, I suppose the main disadvantage is you don't realise the capital value of the business. So you're not getting that lump sum of cash from the business, which I think a lot of business owners like the idea of. And in particular, if you've got someone running the business for you, the risk is that the business decreases in value. So you're not able to capitalise on the full value of the business that you've generated. And you're kind of hoping that the management team or the next generation are able to maintain that value of the business. So that's a consideration that you would have to have if you decided to go down this option. The other disadvantages are you've still got the hassle of owning the company, and that typically means that you're more involved than you may want to be if you just simply sell the business. You are still the shareholders, and whilst you have someone to deal with the day-to-day running of the business, no doubt there will be some duties within the business that you can't offload. It might be dealing with the year-end accounts. It might be dealing with managing the management team or having board meetings and things like that. So there is still some input into the business. Typically, we tend to find in that scenario. The other things to consider is, well, you need to have the right management team or next generation to run the business. So you have to have that option available to you in the first place, I suppose. And you have to have that management team or next generation that are happy to run the business without being the majority shareholders. Some shareholders or some management team might kind of demand, if you like, or require that they have more of a shareholding in the business. So again, it's making sure that that scenario suits your circumstances if you were to go down that route. But from an IHT point of view, it certainly does reduce the inheritance tax payable on the estate. Another option available is to reinvest in business property relief products. So there are effectively reinvestment for BPR relief rules that apply if your proceeds from the sale of a qualifying business property relief asset are reinvested in a new qualifying asset. So in essence, what we're saying here is if you sell your shares in the company that qualifies for business property relief, and you invest the proceeds into a new BPR investment, and there's plenty of them on the market that you can choose from, AIM listed shares and other unit trusts and things like that. As long as you invest within 3 years, that new investment will qualify for business property relief on day one that you buy that new investment. Because what you're doing is you're using the normal you normally have to have a 2-year holding requirement to qualify for business property relief. But what these rules allow you to do is to use the previous holding of the old shares and use those to almost a new holding can piggyback on the old holding that you've already had. So rather than waiting 2 years to get business property relief and making the IHT saving, you get that inheritance tax saving on day one. So what are the benefits? Yes, you retain or you reacquire business property relief. So you will get that £711,000 tax saving if you did invest all the proceeds into these kind of investments. Of course, you may choose just to do some or part, half or whatever it might be of the proceeds. So you've got flexibility over how much you decide to reinvest. You get to realise the value of the business still. That's an advantage. So what I was just saying a moment ago, if you've built the business up and you've maximised the value of that business, at least if you do sell the business, you are cashing in your chips whilst you're guaranteeing the value of the business. And it takes away the risk of the value of the business decreasing going forward. There's lots of investments that you can choose to invest in. Obviously, you would have to take financial advice on that in terms of whether the investment meets your risk criteria and things like that. So you need to get an IFA involved in relation to that discussion. But I think if you're looking at it that you will be saving 40% of an inheritance tax, I think there are investments out there that are relatively low risk and they don't see too much movement in terms of market value. But I think the tax saving alone almost will help you justify the level of risk with any investment in relation to these kind of products. But that's, everyone's different in that respect. So that's something that you would have to consider. In terms of the disadvantage, well, yes, you do have to hold these new investments at the date until the date of death to bank business property relief. But like I said, there is choices out there, so you can dispose of certain investments and reacquire other qualifying investments. But it's just making sure that at the tax point, which is typically when you pass away, you just need to make sure that you've still got that holding in place. In terms of the next suggestion, so the other thing that you could look to do is to make a lifetime gift. So what we're saying here is, and I'm sure a lot of people are aware of the general 7-year rule for inheritance tax. And what we're saying here is that if you've got surplus assets in your estate that you want to pass down to your beneficiaries of choice, let's say your children, then you have to wait 7 years before the value of that gift completely falls outside of your estate. So there is quite a long time period there between gifting the asset and then getting rid of the IHT liability associated with that value gifted. So it's quite difficult to plan for that length of time normally. So it's something that you want to be doing probably sooner rather than later if you're happy that you have got those surplus assets in your estate. The different options you've got in terms of gifting is you can gift directly to your beneficiaries of choice. Obviously, the risk of that is that the beneficiaries have those assets outright. You have no recall to those assets for them to be effective for IHT planning or inheritance tax planning. And it is down to the individuals you've gifted the value to ensure that the wealth is used in the correct way, or what you see as the correct way. And what I mean by that is it is liable to whoever you're gifting the value to. It may be that they use the funds not in the correct way or in an irresponsible way, potentially, on fast cars, holidays, and whatever else it might be. It might be that they get into financial or relationship difficulties and wealth is lost from the family. So in those instances, it might be that you use a trust to make a gift into, just to add a bit more protection on the gift, because ultimately you are gifting it outside of your estate still, but you have control, or the trustees, whoever you appoint, which could be yourself, have control over the use of the assets as well. So that just adds a little bit more protection on the value of the gift made. There is an added advantage of gifting shares in the company that qualifies for business property relief, rather than gifting cash from the sale of the assets. The advantage of gifting shares that qualify for business property relief is that when you gift the shares, they are qualifying for business property relief. And a little bit technical, but in essence, it means that it's not subject to the 7-year rule because of the gift qualifying for business property relief at the time of the gift. That only applies to gifts to trusts, because the trust will bank and retain the BPR relief. Whereas if you gift shares to your children and then you sell the shares within 7 years, that original gift will no longer qualify for business property relief. So it is effectively still subject to IHT in the next 7 years in your name. So yeah, the gift of shares to a trust or to individuals does change, and gifting to trust can be beneficial in those kind of scenarios. So just looking at the advantages and disadvantages. So another advantage is that you can actually benefit from seeing your beneficiaries benefit from that cash during your lifetime. So you can see them using that cash to buy a house, to buy a car, set up their own business or whatever it might be, which can be quite rewarding from the person making the gift as well. We've talked about the inheritance tax savings and what have you. The disadvantages are that there is no IHT saving if you don't survive the 7 years from making the gift, because the value of the gift is still brought back into account for inheritance tax purposes. There is taper relief that applies between 3 and 7 years. So there might be some saving depending on the nature of the gift and the amount of the gift. And like we say, if you do make a gift, you do have to waive all of your rights to any capital or income or any, to make it effective for inheritance tax purposes. So it has to be a permanent, non-revocable gift. Another option is that you could look to use a family investment company. So this is an option which essentially involves gifting a sum of cash to your children, for example. Then it'd be the whole family that introduce funds into the company to invest in whatever they choose to invest in. So that could be rental properties, it could be stocks and shares, or whatever it might be. The inheritance tax saving here is really on the initial gift. So you are making a gift on day one on the basis that it is passed into the company and you've got some control over the use of those funds. So there's a 7-year gift rule there, potentially exempt transfer or a pet. The other advantage is that as some of the company is owned by the next generation or the children, some of the future growth on the investments in the company is actually outside of your estate and is actually directly in your children's estate. So that could be quite a sizable tax saving as well. What we normally find what clients like about this scenario is it gives them flexibility still to get income from the company. As directors, they deserve and can be paid a salary for the work that they perform in the company. So you can still fund your retirement in that way. And another sort of peripheral benefit is that most people that set up family investment companies have had their own trading business in the past, and they understand accounts and the companies and the running of companies. And I think that's quite a skill that they like to see being passed down to their children as well, so that they have that first-hand experience of running a company, what being a director involves, year-end accounts, being familiar with financial statements and things like that. So that's another benefit that we're seeing clients appreciating. In terms of disadvantages, there is an initial gift, so it is subject to the 7-year rule. So there is only an inheritance tax saving if the person making the gift survives 7 years, and there is the hassle of the administration of the company. So you do need to prepare annual accounts, and you do need to file confirmation statements and whatever else it might be. But like I say, that's kind of you can look at that as a positive or a negative. Some people see that as a positive because it gives you good experience of the process. Other people see it as a burden. The only other one that I would put out there is that the other option is maybe investing in agricultural land or something like that, woodlands that qualifies for agricultural property relief. So that's another investment that people might be looking to make to try and reduce their IHT liability. It's just worth bearing in mind that if you buy agricultural property, so let's say fields, and you let it to a farmer to farm, you have to wait 7 years for that to qualify for relief. Whereas if you're farming the land yourself, it's only a 2-year holding period. So that's the another one that is worth thinking about. Okay, so thank you very much. That concludes our webinar today. Just got a couple of queries. So let me just have a quick look at those on the questions, and I'll just quickly run through those. So we've got the first one. I had planned to leave my property business to my nieces and nephew in my will. But if there is a way to include them in the business with a gradual gifting, would that be better tax-wise for us all? You could gradually gift them. The trouble you've got with a property business is that it doesn't qualify for business property relief. So they are going to be taxable assets in terms of inheritance tax. So yes, I would suggest that looking to make gifts would be a sensible thing to do, as long as you don't need the income from those properties. So I think you need to prepare an income summary to understand what you require from the assets you've got to make sure it is surplus to your requirements. The only thing with property businesses that you have to think about is that there will be capital gains tax payable on the gifting of those assets. So even though you're gifting them, for tax purposes, it's treated as though they're sold at market value. So yes, you will need to look at the capital gains tax position. It might be that you can make a gift into trust for some value, because you are able to hold over the capital gain or defer the capital gains tax liability. But it's quite an in-depth question, that one. I think you need to look at the scenario on that just to sort of see what the best option is for you. But yeah, I would certainly say you need to be looking at some planning, because otherwise I suspect if you've got a property business, there will be quite a significant IHT liability. And just a second one, BPR on death. Does this apply if the company is not trading, but the property is rented out and the rent and the income for the business? Yes, you are correct. Business property relief only applies if the business is wholly or mainly trading. So renting out properties, whether they're commercial or residential properties, doesn't apply for business property relief. So you need to have it might be your company does that to a certain extent, and there is a trading activity as well. If that's the case, then as long as the trading activities of the business is greater than the property business, then you will still qualify for the relief. So it's just understanding the makeup of that company in a bit more detail. But assuming it's just a property business, it won't qualify for business property relief. Okay, so I think we're pretty much there on time now. Naturally, if you've got any questions in relation to anything we've talked about today, please feel free to get into touch. You've got our contact details there. You can email us, call us, find us on the website or LinkedIn or whatever it might be. Thank you very much for listening today. And yeah, look forward to hearing from you. Thank you.
Thank you.